Everybody's like, it's a wild, wild west. They're gonna take my home. They're gonna steal my home. They're gonna kick me out my home. They're gonna take it from my children. Oh my gosh, it's not like that, okay? That's hilarious. That's hilarious. All right. No, you have no sense, no. First of all, good morning, afternoon. Where are we at? Afternoon now? Afternoon. My name is McCarthy, AKA TRtheLoanGuy. I am the mortgage broker for Sceptre Mortgage. Hello. All right. I appreciate you for inviting me out. And Erica, the information you gave was spot on. It was everything that I deal with. Yes, it was. I've been doing this for now, last month was 19 years. Wow. So I've been through this whole process of lending for 19 years. I was a processor. I was a underwriter, underwriting manager, branch manager. So I'm pretty versed in this situation called mortgages. So welcome to the first-time home buyers and what you need to know. Negative Nancy or Bad Time Bobby, do you know them? I know you heard them because they say, I shouldn't have to do that. I won't do that. I'm not providing that. You don't need that. And my all-time favorite, I should be able to do that, okay? Please don't be these people, especially in this process of getting a mortgage, okay? The people that are in this room are your friends. They want to help you as much as you want a house. They want to give you, they're the professionals. They want to give you good advice. Does anybody know how much it costs to purchase a home? This question I ask because most people think they know, and I ask them how much it costs, and they just don't have the information. So I want to give you a quick example. How much does it cost to buy a cell phone? You go to your nearby cell phone shop, you tell them you want to get the latest and greatest in technology, as we see here on this picture. 15 years ago would have set you back about $200, okay, with all the subsidies. And now, it's going to set you back about $1,500 to buy a new cell phone. Get that Galaxy S23 Ultra, $1,500. You're going to put down roughly $300. It's about 20% down, and you're going to finance the rest over 24 to 36 months, depending on your carrier. If that's how much it costs for a phone, how much does it cost for a home? What if you multiply that by 300%? 1,500 times 300 is $450,000. Your deposit, 320%, multiplied by 300 is $90,000. Conventional Fannie Mae loans, that used to be the standard. It still is if you want to remove the mortgage insurance from your monthly payments. However, since then, they've come up with other options of 5% down for conventional loans for first-time home buyers, so it's about $22,000. 3% plus the closing costs, okay? So remember this, your down payment plus closing costs. For FHA loans, you're looking at about 3.5% down, which is about $15,750 plus closing costs. As you can see, everybody's gonna say, what about down payment assistance? We will talk about that later in this presentation. Okay, what's the first step? The first step for everybody in this room is to know what your purchasing power is. What can you afford? What is your budget? How much do you have saved? What's your credit score? And the location of the property you are trying to purchase. All of this factors into what's your purchasing power. Improve and maintain your credit. That's the first thing, that's the first line of defense. Obtain a free copy of your credit report. Pay off any delinquent credits if needed. I say that because a lot of people go in there, the first thing they say is, I need to pay that off, and you may not necessarily have to pay it off at that time. Once you come to us, we run certain programs with the credit bureaus to let you know exactly if you need to pay something off or if you need to pay something down. So before you start throwing money at things, let us know first and we'll help you navigate that, okay? Look for any discrepancies or errors in your credit report. Pay your bills on time. And keep your credit card balances low. I always recommend when people want to boost their credit, when you have a card, go get some gas a couple of times a month and pay it off at the end of the month once the bill comes. Take yourself to dinner, pay it off once that bill comes. You show a pattern of paying your bills on time. It will quickly raise your FICO score up over the 6 months to a year. And if you want to get a free credit report, go to annualcreditreport.com. Start saving early. It's never too late. Save for your down payment. The amount is dependent on the type of mortgage and how much the property costs. It's typically anywhere between 3 to 5% on the low end, okay? Save for your closing costs. This is what people are like, what's the closing cost? I don't know. Closing cost includes taxes, property taxes, your insurance, the cost of the appraisal, title and escrow, and also other fees can be in there as well. The typical range is anywhere between 2 to 5% of the loan amount, okay? And again, we're going to talk about down payment assistance later. Wholesale. I am a mortgage broker. I'm a wholesale mortgage broker, which means I have access to, right now, well over 30 lenders, depending on your personal needs, okay? I'm a one-stop shop. But what's the difference between a mortgage broker and a retail bank? I offer loans to a wide range of lenders. If you go down to your credit union or bank, they offer the programs that they offer. We all offer FHA, conventional, some of them offer VA and things like that. The difference with a mortgage broker is we actually go past the traditional stuff into more non-traditional lending as well. When you come to me or you come to a broker, we pull your credit report once, and I can shop it around amongst all my lenders for the program that works best for you. If you go to a bank or to a retail lender and they don't have the program for you, if you go to another lender, they have to pull your credit report again. And everybody always asks the question, is this going to ding my credit? If I just had somebody run my credit 2 weeks ago, I had another lender run it 5 months ago, and I always tell you, go to a broker that you trust, someone that you actually can trust, has been around for a while, knows what he's talking about. Pull it once, be done. And again, a broker's, well, not all brokers, but I'm a one-stop shop for all your mortgage needs, and the banks only offer the products that they offer, just their limited array, okay? Before you shop, step one, get pre-approved. We calculate your income, your FICO score and liabilities to calculate your debt to income or DTI. That's, again, what you have coming in as opposed to what's going out on your credit report. If it's not on the credit report, according to the lenders, it doesn't exist, even though you do have other bills and things, but we go off the credit report, your minimum monthly payments. And then we will issue you a pre-approval to your real estate agent and to you, and you can start shopping. You can start putting in offers, and once they get that offer accepted, because you have a pre-approval, they're more apt to accept your offer than if you did not have a pre-approval going in. Documents required for pre-approval. I'm not going too long, am I?
No, I wanted you to explain pre-approval versus pre-qual.
Okay, that's a great question. Everybody here is pre-qualified for something, okay? You get a loan, you get a loan, you get a loan, you get a loan. I'm not looking at none of you guys' income documents. I don't ask for your paycheck stubs. I'm not looking at anything, but I know that you qualify for something. And so you say, oh, I'm pre-qualified. Doesn't mean a hill of beans if you're not pre-approved, because I can tell you you're approved for 3.5%, right? And if I didn't look at anything, if I don't have any information on you, do I know that for sure? No, and no one does. I have people always come in and say, hey, the guy down the street, my cousin who does loans out of his basement said, hey, he can give me this. I said, did you give him all your information or did he run your numbers? Well, no, he didn't. It doesn't mean anything. A pre-approval is just that. Like I said, you're going to give us these items right here, your 30-day paycheck stubs, okay? You're going to give us your last 2 years W-2s if you are a W-2 employee. Your 2 years tax returns, if you have commission income, if you have rental income, you own a property that you rent out, that stuff is on your tax returns. We need to calculate all of those things there. Your 2 months bank statements to show that you have cash to close. And then the last one, if you are a business owner, 2 years of business tax returns or 12 months bank statements, okay? And I'll get into that later. Once we get these things, we can calculate you guys' specific numbers, not her numbers for her, not your numbers for her, but your numbers, your numbers, your numbers. And once we get that, we know exactly what you qualify for, your FICO score, your monthly payment, all those things, and we say this is your pre-approval. With that in hand, you can now go and say, hey, I'm pre-approved for $500,000. And now you know exactly what it is. Pre-qualification, no one knows. Pre-approval, I'm qualified. I got the documentations right here in writing. Lasts for 90 days, okay? Answer your question? All right, cool. Now, once you get your pre-approval, you can go shopping. Gonna find a real estate agent. Toya's a good real estate agent. She's a very good real estate agent. She got mentees. All right, you find a real estate agent through a personal recommendation, lender online. Make sure you interview them. Make sure you can trust them. I always tell people this. Buying a home is one of the biggest things you're gonna do besides getting married and having kids. Buying a home is next. The person that you deal with, whether it's Toya, whether it's me, or anybody in this room, make sure that they're knowledgeable and that you can trust them. If you do not trust them, they give you a shady vibe feeling, go to somebody else. Even if you don't feel comfortable with me, I'm okay with that. Trust me, I'm gonna be all right. Find somebody that you do trust. I highly recommend that, okay? So find your real estate agent, you're gonna sign a real estate contract, is that about right? Okay, so they can represent you legally, and your real estate agent is paid by the seller at closing. When you buy that house, the seller pays your agent, okay? When you make an offer, your real estate agent will guide you through it. She will also negotiate on your behalf. The types of offer are full price offers, below asking price offers, and over asking price offers. These are important because they all have a role, okay? Why would I offer more than what the asking price? Because you want the home. Okay? That's as simple as that, because you want the home. And I just had one, we just worked on just, was $850,000 was the asking price. They had 3 offers at $850,000. My client says, I'll pay you $865. Guess whose offer got taken? My client, okay? Now, the beautiful thing about it is if the appraisal comes back lower, guess what happens? You only pay what the appraisal is, right? Yeah. So she got back to $850 anyway because it came in at $850. The appraisal did, so we're good to go there. Once you get through all of that, you have your offer accepted, okay? And then you bring the purchase contract to me, and we start the loan process. Any questions? You look kind of confused.
Who, me?
Yes, you.
No.
You got it? All right. Wonderful. All right. Almost done. Your earnest money deposit, you're going to put down, particularly usually about 1% to hold the home, okay? Impacts what happens if you back out of the deal, and it will be applied towards your closing costs. So when you come in, say you have a house that's $500,000, you put down $5,000, that goes towards your closing costs. But that's just your earnest money deposit, holds the home, so they can't sell it from under you, okay? Inspection, you pay for the inspection out of pocket. It details any repairs that are needed or concerns for the property. Often a contingency in your purchase agreement that lets you know, like, if there's something that needs to be repaired, the seller will repair it, okay? Or they won't repair it, depending. Types of loan programs. You have conventional. Fannie Mae, Freddie Mac, you heard of those big guys? They do most of the loans. FHA, Federal Housing Administration, is the government loan that allows you to pay a little bit less, more for first-time home buyers. VA, if you are a veteran, you get to apply for a VA loan as long as you have not been dishonorably discharged. And a non-QM, anything that does not fit into the first 3 is what's called a non-QM. An example of that is if you're self-employed, you made plenty of money, but as Erica said, you deduct everything, so you made $200,000, but after your deductions, you made $2.50, okay? You're not getting a house on $2.50. However, your bank statement showed that you made $200,000 over the course of a year. I can utilize that without your tax returns to qualify you for that loan, okay? So we have different things. Banks can't do that, by the way. All right? Interest rates. Two types. You have fixed and adjustable. Fixed is just that. It goes straight across for the whole entirety of your loan. All right? The adjustable rate goes up and down, usually starts out lower, and it can go up or you can go down depending on the term of the loan. Why would you want an adjustable rate? If the adjustable rate for a fixed period of time, let's say a 5-1 adjustable rate or 5-1 ARM, is flat for 5 years, and then it can do this depending if the rates are down or up. Some people buy a home, they know they're not going to be there for more than 5 years. So they get a lower rate right now, and then they're going to sell it, let's say year 4. It beats buying a fixed rate for a little bit higher interest rate if they know they're going to be there for 4 years. Make sense? All right. Underwriting process, really quickly. Underwriter will review your income documents, the property, the assets, and your credit. Again, they're going to look at it. I used to be an underwriter, so they're going to look at it to make sure you qualify for this loan. I'm going to give you $500,000 to buy a house. I want to make sure you can pay it off, okay? The appraisal is really simple. It's a process that determines the value of the property based on the detail of the home and the current market trends. It says it can take 2 weeks or 30 days. I've never seen it take 30 days. I've seen it take up to 2 weeks, but ours been come back within a week lately. Lender determines if the purchase price is supported, and like I said, what happens if the purchase price is higher than the appraised value? So you offer this much, but it's worth this much. Well, your offer price is going to come back down to where the appraisal is in most cases, unless, go ahead.
I have a question after you're done.
Sure, no problem, sure.
Yeah, it's regarding appraisals, and this is just an example. Right now, with what you're seeing in the market,
Mhm.
and let's say someone came in to purchase the price, the buyer at $375, right?
Mhm.
And we know that houses are still a little overpriced in
Mhm.
some areas, and the appraisal came back lower. What are you seeing happening right now? Are they gonna go ahead and still move forward with the purchase price, or are you seeing them backing out because of the appraisal coming in lower?
It's actually very interesting. I had one a couple of months ago that happened. We thought it was going to be higher. It was like 5 something, and it came back about 30,000 less than what we thought it was going to be. In that situation, they just lowered the price now.
Okay.
Now, I mean, I'm pretty sure in some instances they can just say, I'm not going to sell a house, because it just depends on how much the owner owes on the house, and if that appraisal is lower than what they owe, they're not going to sell a house. Okay?
The buyer also has the opportunity to pay the difference.
The buyer can pay the difference if they want the house still.
You know,
So,
when it was so crazy.
yeah, people were coming in $100,000 more.
I'm writing offers for $100,000
Yeah.
over, plus my seller will be willing to pay up to $50,000 difference on the appraisal.
On the appraisal. I'm not seeing that anymore as much
Yeah.
as I did a year ago.
Yeah.
Because last year they were doing that. I mean,
Like crazy.
yeah, but not now.
Yeah.
People are like, I'm not doing
It's-
that.
Yeah, it's kind of reset.
Exactly,
Buyers.
exactly. Exactly,
They would even waive their appraisal.
exactly. And so now the next step is to get what's called clear to close. Clear to close is once all underwriting is done and we basically say you can close on this loan. Typically takes about 30 to 45 days. We've been closing between 15 to 20 days. Closing agents will prepare your closing documents. You're going to work with your originator, which would be myself, during that time. We're going to skip closing day. Just make sure the notary's going to come out. Takes about 1 to 2 hours. Be prepared to sign multiple pages. Writer's cramp. And your notary will not be able to answer any questions regarding your loan. They're just there to help you sign documents, okay? And the notary verifies your signature. You need to bring your government ID and a smile. All right? And a smile.
You know, a majority of people in this room are first-time buyers. So.
All right. Just going to take 2 more seconds then. Down payment assistance, what is it and how do they work? There are multiple programs out there, and here in California especially. The most common in California are usually what they call Cal HFA or Cal HAFA, GSFA, and then Chinoa. I personally primarily use the Cal HAFA. It's really simple. They have multiple programs, and they're easy to get done, okay? As long as you get the paperwork in, we can close these things. The assistant down payment, okay? How much? They provide anywhere between 3 to 3.5% for your down payment. The amounts depend on the type of mortgage program you have. So FHA, they give you 3.5, conventionals, they'll give you 3%. Does this in the form of a second loan. So the down payment, so let's just say for sake of argument, they give you $10,000 for down payment assistance, okay? That's going to be in the form of a second mortgage on the back end of your property. So say it's 97% would be the first mortgage, the 3% would be the second mortgage. You do not have to pay monthly on it, but you do pay 1% interest that accrues on the back end of that $10,000. Does that make sense? Okay. When does the second have to be paid back? Is refi, so if you actually refi your first mortgage, or if you pay off the first mortgage, you have to pay that back. So if you refinance it, it'll be in the refinance package, you paid it off. If you sell the property, whatever proceeds come from that is going to pay off that second mortgage before you get your money out, okay? And so if none of the above happens, it will then just sit on the back end as a silent second. Any questions on that?
It continues to accrue interest.
It'll accrue interest until it's paid off by 1% annually, okay?
Essentially, if you do like a first-time homeowner loan like this, like CalHFA or anything like that, all you have to worry about is closing costs?
Pretty much, closing costs. Mm-hmm. Now, I do these all the time. I'm doing 2 right now as we speak. And usually when people get these loans, somewhere between 2 to 3 years, they're just doing a rate term refinance and getting rid of it. And it also slightly lowers the rate down. So if you had a FHA, CalHFA, you'll basically slap it back down in about 3 years to get rid of the second and get a lower interest rate, and you just have a first at that point in time, okay? All right. It's a great program, and it's helped many people. All right. Any questions? Any questions? Yes, ma'am.
Regarding the down payment assistance, so I took the NACA program. I don't know if you have thoughts. And I've also done some just preliminary research on down payment systems, and some of them have things where, okay, you have to be in the house for a certain amount of years otherwise, and it seems a bit like there's a lot of penalties, but what if you have to move, like my career is kind of, I might have to relocate, are you seeing that?
I haven't really, I personally have not used a NOC program, but I know people who have. But it's very stringent, and if you have to move, you got to sell a house because they're going to want their money back.
But not so much with the programs you've mentioned, the
No.
down payment assistance.
No, none of those there. Anybody else?
I've Googled it before, so I don't think I found anything, but are there such things as down payment grants?
There are down payment grants. Good question. And CalHFA and Chinoa and GSFA offer grants as well. Usually this is how it works though. If you're getting a grant, the interest rate you're going to pay on it first is going to be higher. So let's just say for sake of argument, like right now, one of my clients, we have a 6.5% rate on her CalHFA down payment assistance. If it was going to be a grant, it would be 7.625. Okay, so it's going to knock her out of the house that she wanted because the higher your monthly payment is, your DTI goes up. So they do offer those. However, the rate's a little bit higher.
It'll raise the
Exactly. So you got to bring the price of the house down. You got to look for a lower price house to get that. You can do that, but if you're stuck on that house, that will probably price you out. But they do it. They do exist. They're out there. We do them.
It's gotta be a pretty big grant to make it worth taking an extra point.
Well, if you don't have the money and they give you the money, and then after, let's just say 6 months of being in the house is forgiven, and you make your 6 months payments is forgiven, some people do that, and then in a year or two, they'll just refinance it. But they got to be able to afford the monthly payment first. If they can afford that monthly payment and they don't have the money to put down out of pocket, it's a great program as well. You just got to know how to use it.
So if you have a high income but not a high savings.
There you go. Absolutely.
So basically, as long as you're able to afford the increased monthly payment from taking the grant, then you should be fine. Otherwise, you just take the traditional method of just taking the
3%.
3 to 3.5% loan with
Exactly.
the added interest.
Exactly. And that's going to go with anything. Anytime, even if you don't have down payment assistance, you got to make sure you can afford the monthly payment.
The monthly payment.
Don't ever put yourself in harm's way for a particular house. Like Toya said, you might take a step back and get a nice house, not your forever home, and start off. I had to do that. I started off with a smaller home and move my way up. You had a question?
Can you explain reverse mortgage?
Absolutely.
And do you think that is a good idea for someone like, because we're building generational wealth with my parents, right?
Mhm.
But we want to see what that looks like.
And I'm going to make sure I make this simple. Reverse mortgages are wonderful products for certain people. It's not like it was 15, 20 years ago. Everybody's like, it's a wild, wild west. They're going to take my home. They're going to steal my home. They're going to kick me out of my home. They're going to take it from my children. Oh my gosh, It's not like that, okay? It's just not like that. With that being said, a reverse mortgage gives you options. And it does. It's a regular FHA loan. So let's just take that. It's a regular government-backed program. I can't take your loan. I can't take your home from you. It's not my loan. It's your loan. It's an FHA loan. So first of all it does is give you three options. You can either make a monthly payment just like you normally do now if you have a home. You can pay principal and interest. Or you can just pay interest. Or you don't have to pay anything, and no one's going to come kick you out your home. If you don't pay the interest, though, what's going to happen is the interest accrues on the back end of the loan. So let's just say you're 65, 75 years old. On Social Security, that's all you have, and you really can't afford to make that monthly payment, but you live in this house. Well, now you have all your income. Besides, you do have to pay your property taxes and insurance. You got to have that. But everything else is for your living expenses now. I can't come kick you out. The bank can't come kick you out until you pass away. Once you pass away, whatever's in your mortgage, your will, trust, whatever it is, that's going to happen. The people who's your beneficiaries have up to a year to do either A, refinance it into their name, or sell it. If you got kids who got 250 credit scores and they can't finance it, they can sell it, okay? They can't get your house no way, okay? I'm just being honest. They can't get it no way. So they have to sell it. All right? If they refinance it to their name, it's in their name. But they have up to a year. You can get longer on a reverse mortgage for the person to come in and refinance it into their name than you do on a regular mortgage. So if I have a mortgage right now and I kick the bucket tomorrow, my kids have it's like 3 months to make sure they get it. If not, the bank's saying thank you, unless it goes into probate. But other than that, that's what happens. So the reverse mortgage is nice. Also, it gives you some extra cushion. So let's just say you have a $550,000 home and you pretty much don't own anything on it, right? At the end of that reverse mortgage, they'll give you, let's say, $250,000. You still have $250,000 in equity. The money goes into a line of credit. When it goes to a line of credit, it's your money. And it adds interest every single month. So let's just say you kept that line of credit. I don't really need the money, but I'm going to put it in the bank for 10 years. After 10 years, you had that $250 plus whatever the interest is on that. Usually it's about 2 to 3%. And so it just grows. So if you pass away, the money's in that line of credit, you can leave to your offspring, and they can still either A, sell the home and get whatever equity is still left over out of it, or they can put it in their name. So either way, if you know what you're doing, it's a great option. No one's going to take your home. Up to you now? All right. That's my time. However, this is my contact information. You can find me at online, any social media at TRtheLoanGuy, and there we go. Up next, though, to piggyback off of me, a gentleman that actually does my own insurance.